Should you buy BOIL ETF? Unveiling the risks rewards of natural gas leverage. What's up, Chat ETF fam? Today, we're diving deep into a fiery topic, the BOIL ETF. Is it a recipe for riches or a route to ruin? Buckle up, because we're about to unpack the risks, rewards, and whether this natural gas beast belongs in your portfolio. BOIL boasts double the daily return of the natural gas market, but hold on, there's a catch, or two. We'll explore how leverage can magnify both gains and losses, and reveal if there are alternative ways to play the natural gas game. Stay tuned, because by the end of this video, you'll know if BOIL is a flaming hot opportunity or best left on the back burner. Let's get chatting. Question 1. What is BOIL ETF? BOIL, or the ProShares Ultra Bloomberg Natural Gas ETF, is an exchange-traded fund designed to deliver double the daily return of the natural gas market. It achieves this by using leverage, which amplifies gains and losses based on a benchmark index. Here's a breakdown of BOIL's key features. Target: BOIL tracks the Bloomberg Natural Gas Subindex, which reflects the performance of natural gas futures contracts. Leverage: it aims to deliver 2x, 2 times, the daily return of this index. So, if the natural gas price increases by 1% on a particular day, BOIL should theoretically rise by 2%. Conversely, a 1% price drop in natural gas would result in a 2% decline for BOIL. Important points to consider about BOIL. Volatility: due to leverage, BOIL's price movements are significantly more volatile than the natural gas market itself. Even small changes in natural gas prices can lead to substantial swings in BOIL's value. Daily reset: the leverage is reset each day. This means that unlike a simple 2x return over a longer period, BOIL's returns can deviate from its target significantly if held for multiple days. Question 2. What is the BOIL ETF's primary investment objective? BOIL ETF's primary investment objective is to achieve daily returns that are double the performance of the natural gas market, as measured by its benchmark index, the Bloomberg Natural Gas Subindex. Here's a deeper look at this objective. Target return: BOIL strives to deliver 2x, 2 times, the daily percentage change of the natural gas subindex. This means it aims to magnify the daily price movements of natural gas futures contracts. Focus on daily performance: it's crucial to understand that BOIL targets a daily multiplication of returns. Unlike a simple 2x return expected over a longer period, e.g., buying and holding for a year, BOIL's performance can deviate significantly from its target if held for multiple days. Here's why daily performance matters. Leverage reset: BOIL utilizes leverage, which essentially uses borrowed funds to amplify returns. This leverage is reset each day. Imagine BOIL as an investor with a pot of money that gets doubled each day to magnify gains in natural gas. At the end of the day, regardless of the overall gain or loss, BOIL starts fresh with the original pot size, adjusted for daily performance, and repeats the leverage process the next day. Impact of daily reset on long-term returns. Due to the daily reset, BOIL's returns won't necessarily translate to a perfect 2x multiple of the natural gas index over extended periods. Here's a simplified example. Day 1, natural gas price increases by 2%. Ideally, BOIL should gain 4%. Day 2, natural gas price dips 1%. Ideally, BOIL should lose 2%. In this scenario, even though the natural gas price rose by a net 1% over 2 days, BOIL's performance might not reflect a perfect 2x gain due to the daily leverage reset. Question 3. Does the BOIL ETF track a specific index? Yes, BOIL tracks a specific index, called the Bloomberg Natural Gas Subindex. This index serves as the benchmark for BOIL's daily performance, with the key objective being to deliver double the daily return of this index. Here's a breakdown of the relationship between BOIL and the Bloomberg Natural Gas Subindex. Function of the index. The Bloomberg Natural Gas Subindex aims to capture the price performance of natural gas futures contracts. These contracts represent agreements to buy or sell natural gas at a predetermined price on a specific future date. By tracking a basket of these futures contracts, the index reflects the overall sentiment and price movements in the natural gas market. BOIL's leverage. BOIL utilizes leverage to amplify the daily returns of the Bloomberg Natural Gas Subindex. This means it essentially uses financial instruments to magnify the index's movements, aiming to achieve a 2x daily return. Here's why understanding the index is important for BOIL investors. Benchmark for performance. The Bloomberg Natural Gas Subindex serves as a reference point to measure BOIL's effectiveness. If the natural gas market, reflected by the index, increases by 1% on a particular day, BOIL should ideally deliver a 2% gain, due to leverage. Transparency and risk assessment. By knowing the underlying index, investors can gain insights into the factors affecting BOIL's performance. Fluctuations in natural gas supply, demand, and geopolitical events can all influence the index, and consequently, BOIL's value. Question 4. If BOIL ETF is actively managed, who is the sub-advisor and what's their investment philosophy? Contrary to your assumption, BOIL ETF is not actively managed. It falls under the category of an index-based ETF. Here's why. Passive management. BOIL tracks a specific index, the Bloomberg Natural Gas Subindex. This means it doesn't involve a portfolio manager actively selecting or weighing specific natural gas futures contracts. Instead, it aims to replicate the holdings and performance of the underlying index. Automated approach. The process of buying and selling futures contracts to mirror the index is likely automated or rule-based. This ensures adherence to the objective of achieving double the daily return of the index. Sub-advisor for index ETFs. Since BOIL is passively managed, it typically wouldn't have a sub-advisor in the traditional sense. However, there could be other service providers involved. Index provider. The entity responsible for calculating and maintaining the Bloomberg Natural Gas Subindex might be considered a partner, but not an advisor managing BOIL's investments. Custodian. The custodian bank holds the underlying assets, likely natural gas futures contracts, that reflect the index holdings. Investment philosophy of index-based ETFs. BOIL doesn't have an investment philosophy in the same way an actively managed fund does. Here's the underlying principle. Market efficiency. BOIL is built on the idea that the market is generally efficient, and passively tracking a broad market index can deliver competitive returns over time. In this case, it assumes the natural gas market reflects all available information, and the best approach is to magnify its daily movements. Question 5. What is the underlying asset class of the BOIL ETF? The underlying asset class of the BOIL ETF is commodities, specifically natural gas. Here's a breakdown of the connection. Investment in futures contracts. BOIL doesn't directly hold physical natural gas. Instead, it invests in natural gas futures contracts. These contracts are agreements to buy or sell natural gas at a predetermined price on a specific future date. Exposure to natural gas market. By holding a basket of these futures contracts, BOIL gains exposure to the price movements of natural gas in the futures market. The price fluctuations in these contracts reflect the overall supply and demand dynamics of natural gas. Leveraged play on natural gas. While the underlying asset class is commodities, natural gas, it's important to remember BOIL's core function. Magnified daily returns. BOIL uses leverage to amplify the daily returns of the natural gas market, as reflected by the Bloomberg Natural Gas Subindex, which tracks natural gas futures contracts. This means it aims to deliver double the daily percentage change of the index. Why not directly invest in natural gas? There are several reasons why BOIL doesn't directly invest in physical natural gas. Storage and transportation challenges. Storing and transporting physical natural gas can be complex and expensive. Futures contracts offer a more accessible and cost-effective way to gain exposure to the price movements of the commodity. Delivery of futures contracts. It's important to understand that upon expiry of a futures contract, BOIL would typically roll over the contract to a further expiry date to maintain its exposure to the natural gas market. This rolling process is usually automated and aims to minimize disruption to the targeted daily leverage. Question 6. Does the BOIL ETF use any leverage or derivatives? BOIL ETF heavily relies on both leverage and derivatives to achieve its objective of delivering double the daily return of the natural gas market. Here's a breakdown of their roles. Leverage. BOIL amplifies the daily returns, gains or losses, of the Bloomberg Natural Gas Subindex. This means it uses financial instruments to magnify the index's movement. Imagine BOIL starts each day with a pot of money. This pot is essentially leveraged, increased, to magnify its impact on returns from the natural gas market. Derivatives, natural gas futures contracts. BOIL doesn't directly hold physical natural gas. Instead, it uses derivatives, specifically natural gas futures contracts. These contracts are agreements to buy or sell natural gas at a predetermined price on a specific future date. By holding a basket of these contracts, BOIL gains exposure to the price movements of natural gas. The synergy of leverage and derivatives. BOIL utilizes leverage to magnify the daily returns of the underlying natural gas futures contracts tracked by the Bloomberg Natural Gas Subindex. For example, if the index increases by 1% on a particular day, BOIL, due to its leverage, aims to deliver a 2% gain. Conversely, a 1% decline in the index would result in a 2% loss for BOIL. Question 7. How has the BOIL ETF performed in different market conditions? BOIL ETF's performance can be quite volatile and depends heavily on the specific market conditions for natural gas. Here's a breakdown of how BOIL might behave in different scenarios. Bullish market, rising natural gas prices. In a bull market where natural gas prices are consistently rising, BOIL's leverage can amplify the gains. This can be attractive to investors seeking to magnify their returns from a rising natural gas market. For example, if the natural gas price increases by 5% in a day, BOIL, in theory, should deliver a 10% gain due to its 2x leverage. Bearish market, falling natural gas prices. However, BOIL's double-edged sword becomes apparent in a bearish market where natural gas prices are consistently declining. The leverage will magnify the losses as well. A 5% drop in natural gas prices could translate to a 10% loss for BOIL investors. Volatile market. BOIL can be particularly risky in volatile markets where natural gas prices experience frequent swings. The daily reset mechanism can lead to magnified losses even if the overall trend for natural gas prices is slightly upwards over a longer period. Imagine a scenario where the natural gas price increases by 3% one day and then decreases by 3% the next. BOIL might end up with a net loss despite no significant change in the underlying natural gas price due to the daily leverage reset. Comparison to underlying natural gas. It's important to compare BOIL's performance to the performance of the natural gas market itself, often represented by the Bloomberg Natural Gas Subindex that BOIL tracks. While BOIL aims for a 2x daily return, due to the daily reset, its returns may not perfectly match double the natural gas market's performance over extended periods. Additional factors affecting performance. Other factors can influence BOIL's performance, such as supply and demand dynamics. Changes in global natural gas supply and demand can significantly impact prices and consequently, BOIL's value. Geopolitical events. Geopolitical events in major natural gas producing regions can disrupt supply and cause price fluctuations. Weather patterns. Extreme weather events can affect natural gas demand for heating or cooling, impacting prices and BOIL's performance. Investor considerations. BOIL's performance is best suited for investors with a high tolerance for risk and a short-term investment horizon. Due to the volatility and potential for magnified losses, it's not generally recommended for long-term buy-and-hold strategies in most investor portfolios. Question 8. What are the key risks associated with the BOIL ETF's investment strategy? BOIL ETF's investment strategy, which relies heavily on leverage and derivatives, natural gas futures contracts, carries several key risks that investors should be aware of before taking a plunge. Here's a breakdown of the main dangers involved. 1. Magnified losses. Leverage amplification. The biggest risk associated with BOIL is the potential for magnified losses. While leverage can amplify gains in a rising natural gas market, it works both ways. Even small price declines in natural gas can translate into significant losses for BOIL due to its 2x daily leverage. Daily reset impact. The daily reset mechanism of BOIL's leverage adds another layer of risk. Even if the natural gas price trend is slightly upwards over a longer period, the daily reset can lead to magnified losses if there are frequent price swings. Imagine a scenario with alternating positive and negative daily changes in natural gas prices. BOIL might end up with a net loss, despite an overall upward trend in the underlying market. 2. Volatility exposure. BOIL is inherently more volatile than the natural gas market itself. This is because it amplifies the daily price movements, leading to potentially large swings in BOIL's value. Investors with a low tolerance for risk might find these fluctuations difficult to stomach. 3. Not a perfect 2x long-term return. While BOIL targets a 2x daily return of the natural gas market index, it's crucial to understand this isn't guaranteed over extended periods. Due to the daily reset mechanism, BOIL's returns may not perfectly match double the natural gas market's performance in the long run. 4. Expense ratios. Like any ETF, BOIL comes with expense ratios that cover management fees and operational costs. These fees can eat into your returns over time, especially if BOIL underperforms the natural gas market. 5. Counterparty risk. Since BOIL uses derivatives like futures contracts, there's inherent counterparty risk. This means that if the counterparty, the other party to the futures contract, defaults on its obligations, BOIL could suffer losses. 6. Not suitable for long-term investing. BOIL's design makes it more suitable for short-term, targeted bets on natural gas price movements. Due to the compounding effect of daily leverage and the potential for magnified losses, it's generally not recommended for long-term buy-and-hold strategies. Question 9. Does BOIL ETF contribute to portfolio diversification? BOIL ETF's contribution to portfolio diversification depends on several factors, and it might not be the ideal choice for most investors seeking well-rounded diversification. Here's a breakdown of why. Limited diversification. BOIL provides exposure to a single commodity class, natural gas. While commodities can offer some diversification benefits compared to traditional stocks and bonds, relying solely on BOIL limits the diversification potential within your portfolio. High correlation with natural gas market. BOIL's performance is heavily tied to the natural gas market. If the natural gas market experiences a downturn, it's likely that BOIL will also experience significant losses. This reduces the diversification benefit, as ideally, different asset classes in a portfolio would have varying degrees of correlation, helping to mitigate risk. Focus on short-term gains. BOIL is designed for short-term bets on natural gas price movements. Long-term diversification strategies typically focus on asset classes with steadier growth trends. BOIL's volatility and potential for magnified losses make it less suitable for a long-term buy-and-hold approach within a diversified portfolio. Alternatives for diversification. There are other ways to achieve diversification within a portfolio. Broad market ETFs. Investing in ETFs that track broad market indexes, such as the S&P 500 or total stock market indexes, provides exposure to a variety of companies across different sectors. Bond ETFs, including bond ETFs in your portfolio, can offer diversification benefits as bonds often have an inverse relationship to stocks. When stocks decline, bonds tend to rise, and vice versa. Commodities ETFs. While BOIL might not be ideal, there are broader commodity ETFs that offer exposure to a basket of commodities, including natural gas, but also other sectors like metals and agriculture. This can provide some diversification within the commodity asset class. Suitability for specific strategies. BOIL could be a suitable addition to a portfolio in specific scenarios. Short-term trades. For experienced investors with a high tolerance for risk and a well-defined short-term trading strategy on natural gas, BOIL could be used for targeted bets. Hedging. In some cases, BOIL might be used for hedging purposes by investors with exposure to assets negatively impacted by rising natural gas prices. However, this strategy requires a sophisticated understanding of the risks involved.